Right now, we're seeing a market that continues to hit highs even as we enter a shutdown. We entered a shutdown yesterday without any clear end to it in sight. Is this a non-event for the market? It may be an event for the economy. We'll talk a bit about that some more, but is this just officially a non-event?
History shows that government shutdowns are indeed a non-event, both for the economy and for the markets. Now, in the short term, there may be some effects on things like maybe a rise in jobless claims, depending on how furloughs are treated, maybe lowering airline traffic, things like that, but very temporary, not things that are going to interrupt the overall trend. And the use of the word trend, Frank, I think is very important here. You know me, you know I'm a fairly analytical person. I like to use numbers. I don't like to engage in the banal, trite sayings like I'm about to say, which is that the trend is your friend in the markets right now.
Okay, which trend, though? Are we talking about the trend of the Fed cutting rates? Are we talking about tech hitting new highs? Is it artificial intelligence? You got to name one trend.
Well, I was going to, my friend. Start off with keep it simple.
You did it, it was trite.
The equity markets, all right? The trend is higher. And you have to think, I mean, now I'll go a little deeper. Let's go into the AI trade. If you're out there and you're saying to yourself you're going to sell NVIDIA, like really? With this amount of momentum behind it? Sure, get behind whatever bear argument you want to make, whether it's DeepSeek or CapEx one day is going to fall off. But really, with this momentum going, you're going to sell it? Good luck with that. And I think when I speak to the trend being your friend, what I'm specifically speaking to is that any dip in the markets is highly likely to be bought. Now, of course, the markets can go down and probably will sometime this month. But consider that something like 25% of professional managers are beating their benchmark this year so far. That means the other 75 are feeling a little bit desperate right now, and they're going to buy any dip. And actually, it's not just AI. So again, Frank, giving you more on this, and not to take anything away from Shannon and Jason, what you may want to say, but if you look at the strong recent rally in pharmaceuticals and healthcare, little give back today, I got it, but still a strong rally, that is people saying, okay, I've got to catch up. Maybe this is a way to do it without having to take the add to the AI that most people already have. I can look at healthcare. I can look at financials, any of a number of areas, meaning the trend really is towards an everything rally here.
All right, Shannon, I want to come to you with kind of dovetailing off what he had to say. If you look at the trend over the last week, short time frame, but over the last week, the S&P equal weight outperforming the market cap weighted S&P. Another area of the market that's hitting an all-time high. We talked about tech, utilities. Now, I think a question for you, is that a broadening or is that simply a trade related to AI where people are seeing the incredible amounts of power needed and utilities are the beneficiary, or is it a safety trade, a broadening? I mean, interpret this one for us.
So if we're talking specifically about utilities, then Frank, I would say you could look over the last year and there's been significant correlation to the AI trade in terms of how utilities have performed. So if you look at from a year-to-date perspective, utilities are one of the top sectors in terms of performance out of the S&P 500. However, what I think that it's important here is that there's more than just the AI trade as it relates to utilities. So we talk a lot at Neuberger about the potential for a global industrial impulse to help drive growth in 2026. And so if you think about the power demand that exists not just from the AI trade, obviously more pronounced in terms of talking about data centers and the power that's necessary to be able to fuel this AI revolution. But you look at the sort of the backlog of infrastructure improvement that is necessary. You look at the necessity of improving infrastructure, not here just in the United States, but also abroad. And you look at things like the fiscal stimulus that's likely to unfold in Europe. So there is a bit of a push or a tailwind in terms of utilities. I would say I would be hard-pressed to find people looking at the broadening trade as an example of people looking to potentially hide out in defensive sectors. That's really not where we've seen that. If you look at something like consumer staples, for instance, the performance just isn't there in terms of wanting to potentially diversify away some of the beta that you're getting in the U.S. large cap names, particularly technology. And so for me, when I look at this, there are certain sectors that are no doubt, potentially kind of the second derivative of what's happening in the AI trade. This broadening out, though, has really encompassed sort of the next trend, if you will, in terms of there's been a lot of CapEx put forth in AI. Where is the next phase of that CapEx? And that's really going to be in sectors outside of technology that are going to start to integrate and implement some of this innovation in their businesses.
Is valuation also an issue when we're looking at the broadening? If you look at technology right now, it's trading at about 31 times forward earnings. The 10-year average is about 21.5. Do you think investors potentially, at least, getting some religion about these valuations, specifically in the tech sector?
I would would say it's less about getting religion because honestly, we haven't seen the deceleration in earnings and technology that we maybe anticipated coming into this year, which we thought was going to be a driver of the broadening out. Instead, what I think you're seeing is that, there are opportunities outside of those technology names. I would also point to the earnings picture. If you look at third quarter earnings, Frank, by many accounts, those look fairly conservative. And so if you think about the potential for a continued earnings growth from technology, but also maybe more conservative estimates in some of these other sectors, I think it speaks to getting ahead of some of the positioning. We only have 2 weeks until earnings season kicks off in earnest with the financials, and so kind of positioning ahead of that. That's what I'm looking at in terms of maybe less concern about valuations, more positioning for what could be another strong earnings season in terms of percentage of beats.
Jason Snipe, what moves are you looking to make? Are you looking to trim maybe some winners? Because we can't forget, we don't really know the outcome of this shutdown. And while historically, it doesn't have a big market impact, the longest shutdown ever was under the Trump first administration. It was 35 days. That would certainly have an economic impact that could impact a lot of these big name tech companies and other parts of the market.
I mean, it's 35 days in 2018, but the market, the S&P was up 10% during that time. And then we've had 14 shutdowns since 1981. It's been historically a non-event, right? GDP's up over close to 3.8%. As Shannon described, we have earnings starting in earnest in 2 weeks. We're expecting close to double-digit earnings growth for the for the broader sector, for the broader segment. So for me, as it relates to, you asked me what would I be doing here, I think Jimmy makes a great point on the chase. The chase is real. Obviously portfolio managers, there's a lot of lag there where we're not performing as they had expected for the year. So, we have to submit those report cards at 12/31, right? So I think that's a real story. I think as it relates to the earnings story, clearly it's been a lot of concentrated growth in the AI names. I do think some of the more cyclical oriented sectors, healthcare obviously has had a nice bump. This week has been a lagger so far all of this year, but I would be looking to reorient some of my exposure into some of the sectors who have not grown.
But wait, where's that money coming from? Are you trimming some of your winners to get into those sectors that have been unloved, or are you simply just widening out your bets?
I think there could be some. I think obviously it's always prudent to take a little bit off the top from tech. Tech as you described. I mean, 30 times earnings. I mean, these are lofty valuations, but the earnings have supported it. That's why we've seen the expansion that we've seen thus far. So I think it's a little bit of trimming from some of those sectors, but I think also, for folks that have some cash on the sidelines, it's looking to more of the cyclical-oriented names.
All right, so a little bit of trimming, but you still want to stay with what's working.
Absolutely.
I want to bounce something off you, Jim. I'm going to get your take on this first. Tom Lee out with a note earlier today. He says, among other things, history shows probabilities favor the S&P at 7,000 by the end of the year. He goes on to say there's a strong seasonal tailwind underway and the upside is higher given the Fed is dovish. And I want to ask you guys about that. Are we sure the Fed is dovish without the information from the jobs report, potentially from CPI, potentially from PPI, but I'm going to continue. We urge looking through the messiness of the shutdown and even the lack of data that stocks are weak. He says he would buy the dip. Don't go defensive. Tom Lee saying do not go defensive. Agree or disagree? And is every dip viable? I mean, at a certain point, doesn't that strategy have to not work?
Yeah, of course it has to work at some point in time. And again, I don't want to be carefree in saying that right now the dip is viable, but the dip is viable right now. Look, and I read Tom's notes. They're always worth reading. And one of the things he pointed out, and this is to your question, Frank, is that with the Fed kind of now flying blind, and all of us flying blind in terms of data, they're likely to err on the side of caution, i.e. they are more likely to cut than not cut. Now, the next meeting is when? October 29th, I think? October 29th?
Decision on the 30th, I think.
Yeah, so we may have the shutdown over by then, but still, if you look at the probabilities, I believe they're close to 100% that we get a cut in this month. And I think, again, this shutdown really corroborates that. With the overall target of 7,000, sure, why not? That's roughly 4% higher from here. Again, I don't mean to sound carefree. You know I'm kind of an analytical person. We all know that, and we all are. But this factor of people chasing performance, it's not to be trivialized. It's happened in many years like this where you've had a strong year, whatever we're up 14% year to date on the S&P 500, and especially with that whoosh down that we had post-Liberation Day, let's face it, some people, some managers raised cash. and now they're struggling to catch up. That was just simply, it turns out, the wrong move. I'm not judging them, it just was the wrong move. So any dip here is going to be viable, and as I think we're all saying, it inures to more than just the AI company's benefits.
All right.